Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to the first webinar of this week, a very important webinar because we're going to be looking at exactly what is driving a change in the risk appetite on the market and the price sentiment of the market, investor sentiment towards the stock market. So what is driving this? This is something specifically that we have seen over the last 24 hours. So we're going to be looking at how fundamental analysis has changed from 2023 to 2024, but we're going to be looking at fundamental analysis recently, so over the past week, but something even more important, what is currently the bias in terms of fundamental analysis going forward. So what potentially is able to happen over the next coming days, the next coming weeks, and the next 2-3 months. So this is what we're going to be looking at as part of today's webinar. We are going to be looking at technical analysis to a very small aspect as well towards the end of the webinar. So I've got somebody who's already asked a question: are we only going to be looking at fundamentals, or are we going to be looking at technicals as well? Towards the end of the webinar, we will be looking slightly at technical analysis. And we will also, at the end of the presentation, very quickly go into the MT5 and look at exactly how the price has moved over the past 1 hour. Now, these webinars, ladies and gentlemen, they're of course here for educational purposes. So it's very important for everybody to understand that when you are trading, trading is a form of investment, and you of course have no control over how the price is going to move or potentially going to move. So you have to understand this, you have to be comfortable with this before proceeding to a full investment. As part of these webinars, we do not give investment or financial advice, but what we do want to do is give as much educational material in order for you to be active in the financial trading markets with full knowledge. The last thing I wanted to say is these webinars, of course, are always based on a specific topic. For example, today's webinar is based on fundamental analysis, but of course, they are a great opportunity for individuals to ask their own personal questions. So if we have anybody who is interested in fundamental analysis, but they have also additional aspects of the market that they're personally struggling with, then of course, keep in mind that these webinars, you have full access to ask as many questions as possible through the GoToWebinar software, and I will answer the questions live. So we have so many occasions where we may be looking at one specific topic, but somebody wants to share something that they personally have experienced, maybe that day, or generally speaking, that they want some educational material based on. And of course, all questions will be answered live as part of the webinar. I've got a question here already. Somebody says, how long will today's webinar be? Ideally, I'd like it to be 45 minutes long. Now, if it's going to be slightly longer, it depends. It also depends on how many questions we have. But ideally, I'd like it to be 45 minutes long. But I don't want to spend too much time on this slide personally, but I always have this slide here because it is good to know a little bit about the individual who is providing you with this information. Like I said, I am the market analyst here at HF Markets. We have many analysts. I am one of those analysts based in the headquarters. To give you a bit about my background, I originally started off as a financial advisor, which I was for 4 years. I've been a market analyst now for also an additional 6 years. So I've been trading and investing for 10 years and been in the financial service market for 10 years. Here at HF Markets, we have my personal webinar series. What I want to do is provide as much educational material, not only for beginners, but for individuals looking to get more experience in terms of institutional experience. So really looking at how institutions are looking at the market, because there's a lot of educators online, but a lot of the educational material that they provide is purely rubbish and something which is irrelevant, something that none of these institutions, whether we're looking at investment banks, hedge funds, and so on and so forth, will ever be looking at. So I want to clear that up and give as much educational material and get people really looking at the market from an institutional view. So really looking at institutional level of analysis. But of course, I want to be doing that in the simplest form possible in order for everybody, whether you have 6 months experience or 6 days experience or have never traded before, to get an understanding about how you can personally input it on your day-to-day trading, if that's something that you wish to do. So main price drivers of 2024, and of course, what is the difference? What is changing in terms of the domino effect within the market from 2023 all the way to 2024? Now, in 2023, ladies and gentlemen, we have to keep in mind that inflation had hit its peak. Central banks all said that inflation towards the end of 2022 hit its peak, and it was, and also we had, and we're going to look at this on the chart. I've actually pinpointed on the chart where specific events took place, but something which really, as individuals, we saw in 2023 was that interest rate hikes were consecutively taking place month after month. Each federal decision was another interest rate hike, sometimes even 75 basis points as well. So it was a question of inflation had peaked. How much is it going to decline? That was the main question and influence of 2023. Towards the end of 2023, then we really started to get the question of, has interest rates peaked? And when is there likely to be an interest rate cut? Now that we are in 2024, we're not looking at the same influence. This time, we're not looking at if inflation has peaked. The question is, how sticky is inflation going to be? So there's a big difference there. Are we able to get inflation down to that 2% target while keeping the possibility of a soft landing alive? So that is really what is going to be the key influence of 2024. How sticky is inflation going to be? Are we able to get inflation down to 2% without another interest rate hike? And the third is, are we likely to get inflation down to our target without causing a recession or without causing a hard landing? Are we still able to do so while maintaining a strong employment sector and maintaining economic growth, with certain regions experiencing economic growth? Not all regions are expecting that. So some countries are also witnessing stagnation. Some countries are also witnessing economic contraction. A good example of stagnation, for example, is China and the UK. So what exactly is inflation? Inflation, ladies and gentlemen, is the price alterations from month to month. So for example, if the inflation rate in let's say 2023 is 4%, just an example, then that means in that year prices increased by 4%. Then you also have stagnation, where prices are neither increasing or decreasing, and then you've got deflation, where prices are actually decreasing. Now, some people, after 2 years of very high inflation, in some regions we even had hyperinflation, may say that deflation is not a bad thing. Deflation, though, ladies and gentlemen, is definitely a very negative aspect of the market, which can be experienced and hopefully isn't going to be experienced. Deflation is not a positive thing. I'll give you a very good reason why deflation is not a good thing. keep in mind that when we look at deflation, everything is becoming cheaper. The prices are actually declining. So people may say that's a good thing because it means everything becomes more affordable and people are more willing to spend, and it drives the economy. But it doesn't actually have that effect because traders and investors and consumer psychology doesn't quite work that way. When you actually have deflation, it actually means that people are scared to buy assets, whether it's an investment or whether it's something they need for their household or whether it's food and so on and so forth. Because what it actually causes is, because people fear that if they purchase it, it will be devalued, or because they may need the assets, but they may hold off purchasing it because they know that in a month's time or 6 months' time, it will be cheaper to buy. So actually, it halts economic activity, decreases economic activity. So I've got somebody who says he cannot hear even though he can see the content. From what I can see, everybody can hear. If anybody is having similar issues though, please let me know. Otherwise, if that individual can exit the webinar and then re-enter, maybe that's the issue. So deflation, definitely not something that we want to see. What we want to see though, ladies and gentlemen, is that we're neither seeing deflation, neither seeing stagnation, or seeing high inflation. We want to be at that 2% target. Now, we have consecutively month after month after month in both Europe and the UK and US over the past 6 months, seen inflation decrease consecutively. Now, for the first time in a very long time, it's the first time since August for the US and the first time since April of last year for the EU, we have seen inflation increase in value. So for the US, it's increased in value from I believe 3.1% to 3.4%. Even Germany, the largest economy in Europe, actually saw inflation increased by 0.1%. So really this, ladies and gentlemen, is higher inflation than what was previously expected and than what was previously being priced into the market. So today we're going to look at what kind of effect that's going to have on the US dollar and on the stock market. And there's a very significant reason why that is important. Now, what a lot of people would have possibly seen, if anybody has even some very small experience in the market, would have seen is that stocks have become extremely expensive. We've seen a very strong upward trend in the stock market, specifically when looking at the NASDAQ, which has also been driven partially by very high earnings and artificial intelligence. But what is actually being priced in the market, and what people would have noticed if anybody's following the markets, is that yesterday and today we have global finance giants, institutional banks, finance ministers, politicians, and so on and so forth are all meeting in Davos in Europe, and I have been speaking to journalists non-stop every single day. And what individuals are saying is that traders and investors are getting ahead of themselves. Some people's folks, a good example of this is JP Morgan has actually said that traders are actually pricing in 6 to 7 interest rate cuts in 2024. Now, if you compare that with what economists believe is going to happen, that's double. Economists believe that the market is actually likely to see between 3 and 4 interest rate cuts in 2024, and most of them have all said it's going to be towards the end of the year, whereas prices are showing that traders are pricing in 6 to 7, so double that, and actually starting in March, so that is in 2 months' time. So there's a big difference there. So if we're not going to see 6 to 7 interest rate cuts this year, then the market, according to most banks and economists, are getting ahead of themselves and unaccurately pricing stocks, which is also potentially why the stock market has been very expensive. But of course, this is a very big if. We need to see what kind of price move, what kind of developments we're going to see from central banks, from inflation and from interest rate cuts throughout the year. And this is something that I'm going to speak about in another slide. Now, In 2023, especially in the first 6 months, we really saw a strong upward price movement, which was being driven by artificial intelligence. You'll see on the next slide that in the first half of 2012, well, more than the first half of 2023, we were still seeing interest rate increases, strong interest rate cuts. Now, even though the higher interest rates are, and the more interest rate hikes there is, the more negative this is for the stock market. But the stock market saw such a strong bullish trend upwards. So why was that, especially in the first half of the year where we were nowhere close to interest rates being peaked? The answer is, ladies and gentlemen, is that that was being driven by artificial intelligence and demand from artificial intelligence. Now, the question is, because that's not likely to continue every year, year after year after year, including 2024. A lot of people have bought, a lot of people have invested, even many of the people who are watching today's webinars may be shareholders in Apple, Microsoft, Nvidia, AMD, and so on and so forth, which really have been experiencing bullish price movement because of the AI trend. All these shareholders, whether institutions, professional, retail traders, want to now see if these companies can monetize artificial intelligence. Now, what do I mean by that? Can they actually take this service and this product and make money from it? Or is it just something which has been released into the market, which has no actual monetary value to the company? So this is the next question. This was an influence in 2023. Artificial intelligence. The more a company had, the new products and how positively they worked really drove stocks. But now 2024 is all a question of, are people able to monetize it? Are we able to make money from this new product? The next thing is economic growth. This is something that we're going to speak about throughout today's webinar. The main question is economic expansion able to maintain momentum over the next 3 to 4 months, now that interest rates are extremely high, very restrictive, and also not likely to see any potential interest rate cuts in that period. Now, something which I will mention is you have to keep in mind that interest rate hikes have a lagging influence in the market. So, for example, in Europe and the UK, the lagging influence is not very large. So if you see interest rate hikes, they're likely to have an effect on the markets as quickly as between 2 months all the way out to 9 months. So a very short period of time. In the US, they have a larger lagging effect, especially when being compared to the UK, because a large part of the UK economy is reliant on real estate. So in the US, it actually has a much larger lagging effect. It's actually between 12 months to 2 years. Now, if we're going to focus on the first hike, then what is actually going to, if we're going to focus on the first hike and we're going to work off 1 year, it's already having an effect on the market. Now, if we're going to take the first hike and look at 2 years, it means that we actually should be seeing an effect on the market. So contraction and low consumer demand by March of this year. And this is why a lot of economists are actually voting and predicting that interest rate cuts will start in March of this year. But it's a big if. This is something that we want to see, but it's very, very key to see if the economy will slow down, including economic growth, gross domestic product, and employment in March of this year, because that is the end of the lagging effect. That is officially, if we're looking at economic theories and looking at the US economy, when we should really at the latest start to see an effect on the economy. If we don't, it means very simply that these interest rates hikes are resilient. The economy is resilient to the hikes which have actually taken place, which means the question is, are we able to get inflation down, or are we potentially going to need another 25 basis point hike. Now, the next thing that's just going to be a very big influence and price driver in 2024 is the geopolitical tensions. We're going to speak about that in a moment. And also elections is one of the first years in a very long time that we're going to have this year half of the nations and population of the world actually going to be experiencing a regional election. This includes the UK. It also includes, for example, the US and many other countries. We've already had one election, for example, from Taiwan. Right, this is the NASDAQ, ladies and gentlemen. This is the USA 100, and we're looking at the price movement all the way back to 2020, but we're not going to look at the price. I don't want people to concentrate on it in 2020, 2021, but actually we really want to look at what is happening in 2022, 2023, and this year so far. And there's something specific that I'm pointing out to individuals. When we're looking at this first red line here, ladies and gentlemen, which was in March 2 years ago, so we're very close to coming up to 2 years. This is where the first interest rate hike actually took place. And we can see that after that, we had consecutive interest rate hikes, at some even being as high as 75 basis points. And we actually saw the stock market decline by 26% when looking at the NASDAQ. Keep in mind that's 26%, and it already had declined in the first few months of 2022. So if we're looking at the overall decline of the year, the 12 months, we're looking at almost 35% decline. So a very clear stock market crash in 2022. But then if we look at January 2023 onwards, we had a very, very strong upward trend, largely driven by higher earnings, yes, but largely driven by the artificial intelligence trend. Now, in this period here, especially in the first 9 months, we had, again, consecutive interest rate hikes month after month after month, but it wasn't having an effect on the economy. Actually, the stock market actually almost fully corrected, ladies and gentlemen. So the stock market increased in that year by 40%, even though we had many interest rate hikes. Now, after that, we had a further increase of Now, the last interest rate hike that took place was in July of 2023. That was the last significant interest rate hike. We actually had more interest rate hikes after that, but that was the last very large interest rate hike that we saw. And even after that, we still had another 9% being added onto the NASDAQ. Even in 2024 so far, in the first 15 days of the month, the NASDAQ is trading higher. So the question is, ladies and gentlemen, is the price of the NASDAQ too expensive? Is it overpriced? Are traders indeed getting ahead of themselves? Now, it all depends on the following, ladies and gentlemen. It all depends on, are we going to see interest rate cuts in March? Because this is what is being priced into the market. The second question is, are we going to see 5, 6, 7 interest rate cuts in 2024? Now, if either of these two are wrong, or if both of them are wrong, then investors are inaccurately pricing the NASDAQ. It's as simple as that, ladies and gentlemen. Now, this is not me giving that advice on that bias in the market. Anybody that has been watching Bloomberg and Davos over the past 24 hours will see that JP Morgan has said so. The European Central Bank has also said so. The president of the Bank of Germany has said so. And if we look at the past week, especially after the inflation data on Thursday, we had all the members of the Federal Open Market Committee come out and said that it is unlikely that they're going to see interest rate cuts in March. The only thing that can potentially change this is, like I said, in March, we're exactly 2 years after interest rate hikes started to take place, in which case we should start to see, at the latest, we should have already started to see, but at the very latest, we should start to see some kind of contraction within the employment sector and within the economy. Otherwise, again, interest rate cuts are unlikely to take place. So we have to think about, when we're looking at the Federal Reserve wants to reach their 2% target. They will not settle for 2.5% or 3%, even though it's much better than 10% that they were seeing a year and a half ago. Why? Because if they're not able to get it down to 2%, there is still a high risk of inflation increasing again. Now, this is something that we saw last week. Inflation has already increased. So the central bank will not settle for less than 2%. And at the moment, there is no pressure on the central bank to think about settling on interest rate cuts. They're not willing or pressured to settle on a higher inflation rate. Why? Because there's no pressure. Because the employment sector is resilient and it's very strong. We're going to look at the employment figures in a future slide. In addition to this, the US economy is very strong. Global economy, even though in other regions they're not experiencing strong economic growth like in America, they're not necessarily seeing a recession either. So there's no pressure on the Federal Open Market Committee, even though investors are pricing in a higher price and pricing in interest rate cuts. There's no pressure on the Fed actually to do so at the moment. So is another interest rate hike possible? We have to keep into consideration inflation has risen in not only the US, but it's also risen in other areas. For example, it's risen in Germany, it's risen in the EU, and tomorrow morning we're going to get another inflation reading, this time from the UK. If UK inflation also increases in value, then it's really a scenario that there is no significant pressure to decrease interest rates and to consider interest rate cuts. The only positive scenario, the positive current factor there is at the moment in terms of interest rates and inflation, is that Asian countries are starting to see lower inflation. For example, China is actually experiencing deflation, and they are known to be a carrier of global inflation. So the fact that they're seeing deflation is positive for global inflation. Also, Japan saw lower inflation, and other Asian countries did. But we want to see that also in the West, in the European Union, in the UK, and most importantly, in the United States of America. So this is putting a doubt on the chances of actually seeing interest rate cuts in 2024 at the moment. Now, if we're really going to see the possibility of that vanish, this at the moment we're looking at it unlikely to take place in the first 2 quarters of the year, and likely to take place in the in the third and fourth quarter of the year. So this is still not what is being priced in the market, but this is at the moment what is being advised is the likely outcome. But if we get 2 months of inflation increasing, so for example, it's increased from 3.1% to 3.4%. If next month it increases again, even if it's a small increase to 3.5%, 3.6%, the possibility of interest rate cuts really does start to vanish based on that potential economic data, if that data does come about. Now, oil prices and inflation, the question is it due to rise because of the Red Sea crisis? So this is going back to geopolitical factors, which I mentioned on the first slide. Most people would have seen that in the Red Sea, in that region between Africa and the Middle East, which is a very, especially for Europe, a key route for shipping and transportation, oil imports and exporting goods. It's very key, and a lot of shipping companies, a lot of countries have rerouted their ships, and what it's actually so far doing is creating disruption in supply. Now, if the geopolitical tensions do rise and we get a higher oil price, which oil hasn't really increased in value, but it's slightly ticked higher, or at least lost its downward momentum, which is understandable as well. And in addition to this, we start seeing inflation rise because of disruptions to supply. Then really that's a scenario, ladies and gentlemen, which is worrying for the global economy, because it actually means that inflation is going to be stickier, inflation can potentially rise, it can have an effect on company earnings. And lastly, in addition to this as well, interest rate cuts become less likely, especially if inflation continues to rise or remains high. Most analysts do not expect another interest rate hike. However, if inflation rises for a second consecutive month, this possibility can potentially change. So if we're going to see 2 months of consecutive higher inflation, especially if we see it in Europe and the UK as well, or even a third month, that really changes the scenario of a potential another interest rate hike. At that point, there is a possibility, and something which people can do is they can follow the CME FedWatch tool, which gives a potential possibility on what kind of movements the Fed may have and take. That really will change the scenario. And then another, even if it's a small interest rate hike, for example, 25 basis points actually is put onto the table. And again, something like that, a scenario where we have 2 months of higher inflation and then another interest rate hike, even if it's only 25 basis points, can have a detrimental effect on the stock market. Because what that actually does is it really lowers the possibility of a soft landing. So you're looking at a scenario of higher inflation, even if it's not 9, 10, 11% like we were seeing. Nonetheless, it's still higher inflation, higher cost of debt, and it's likely to create a significantly lower level of consumer demand. And it can create even a hard landing or a recession. Most bankers continue to advise hikes are not likely, a most likely outcome, of 2024. However, the question is how many cuts. So the question is, the market is pricing in between 6 to 7 cuts, whereas bankers are actually saying it's more likely to be 3 to 4. Now, depending on which are correct, if it's going to be 3 instead of 6, 7, then again, the market is incorrectly pricing the NASDAQ and US stocks and also European stocks as well. Then the next question is it going to be March or is it going to be May, June? So far, the Federal Reserve has said it's premature to start looking at interest rate cuts. So March really looks unlikely, not impossible, but unlikely. Of course, that may change. And even May is starting to look unlikely as well, potentially. So let's now look at the employment market. The main thing I want people to understand about the employment market is that it's applying no pressure on the Federal Reserve, ladies and gentlemen. People were expecting inflation by this point to be at 4 to 4.4%, actually, depending on what economists that you were following. A lot of people said also that the Federal Reserve are not likely to consider an interest rate cut unless the unemployment rate reaches 4.5%. If we look at the unemployment rate in December 2023, so 1 year ago, it was at 3.7%, was expected to rise to 4.4. If we look at it December last month, so actually January of 2024, it was released for December. It's completely unchanged, and we never ever got 4% throughout the year. So the employment sector is resilient. It's extremely resilient. Even if we're going to take into consideration the lagging effect of 2 years, it still should be seeing some kind of movement there, which it hasn't so far. If it doesn't by March, then that's really a scenario where there is no pressure on the Federal Reserve to actually consider an interest rate cut. Now, the only thing I would say which is slightly different is that the employment sector and employment data, such as the unemployment rate, is actually a lagging indicator. It's one of the last thing that changes. So if a lot of people say, very famously, an economist once said, if the unemployment rate has risen, it's too late. This is the last thing that will actually take place. The unemployment rate will start to rise. If it started to rise, the central bank and the regulators and the Federal Reserve is too late. So it's really a scenario that if the unemployment rate starts to rise, it will pressure the Fed. But if it rises to a point, it can also indicate that it's too late. The Federal Reserve applied too much pressure. Either they applied too much pressure on the economy, or the scenario of being able to create a very restrictive monetary policy, pressure inflation, and have a soft landing is not a possible scenario. So this is something which is really important, ladies and gentlemen. The federal fund rate between December of 2022 up to December 2023 increased by a whole percent. So that's quite a large increase, ladies and gentlemen. Interest rate hikes can take 1 to 2 years to take an effect. We've mentioned this. If the employment remains resilient, there's little pressure on the Federal Reserve to cut interest rates unless inflation gets closer to its target. So it can be a possible scenario that if inflation does not necessarily reach the target, but gets closer to the target, for example, reaching 2.5%, and the unemployment rate reaches 4%, then that's a scenario potentially where the Federal Open Market Committee will think about an interest rate cut, even if it's going to be just one interest rate cut. Whereas if inflation declines to 2.5%, but the unemployment rate is still very low at 3.7%, they will consider going all the way until it reaches 2%. Gross domestic product. Let's look at the US economy compared to the Japanese, compared to the EU, and compared to the UK as well. So let's look at the US economic growth. This is based on the gross domestic product. So if we're looking at economic growth in the first 3 quarters of 2023, we were seeing strong economic growth in America, higher economic growth than what was previously predicted. If we look at the economy in the 3rd quarter of that year, we haven't had the 4th quarter just yet, but we saw the economy grow by 4.9%, very high. Really not showing any signs of a restrictive monetary policy, so very expansionary. Also, the US economy has grown for 5 consecutive quarters. That's also very important to keep in mind. And also, it's very important to note that the economy grew at its fastest pace in 2 years. And of course, keep in mind, 2 years ago, it was very high, the economic growth, because we had COVID-19. So we saw a very strong decline. So of course, in a year after that, the GDP growth rate was very high because we were recovering. We weren't necessarily growing. We were just trying to make up lost ground. Whereas if you're looking at other economies, the German economy is actually experiencing stagnation, and it's even experiencing at time a slight decline. We're currently looking at a slight decline for 2023. Not necessarily a recession, but a slight decline. The possibility of a shallow recession still remains. The French economy grew only by 0.6%. The latest quarter figure is not available, so for 2023, it could be 0.6, could be slightly higher, could be slightly lower. Nonetheless, it's low if we can compare 4.9 to 0.6, very big difference. The UK economy really again experiencing stagnation. It's only grown by 0.1%, and that was saved last month, ladies and gentlemen, because we saw in December growth reading 0.3%. Otherwise, we'll be looking at a decline for the UK economy of 0.5%. So again, they were very much saved in the last month. Also, other figures for the UK economy are not great. If we're looking at insolvency, so bankruptcies, the number of companies registering bankruptcy in 2023, it increased by 14%. This is something that a lot of economists and traders have spoken about. In 2023, it increased by 14%. So we can really see some pressure on the UK economy there. The Japanese economy grew by 4.1%. Not significant economic growth, but not stagnation either. So a positive scenario there. Also a very, very cheap currency. So if we're able to continue to see Japanese economic growth, some demand for safe haven assets and currencies away from the dollar, and we also start to see the Bank of Japan start to move away from that ultra dovish policy, then that is a very potential currency there to look at long-term speculation of upward price movement. Why? Because the Japanese yen at the moment is significantly cheap, and they're really looking at a possibility now, and a lot of speculation around the fact that they may consider moving away from their ultra dovish territory. In terms of this, ladies and gentlemen, if economic growth continues and employment remains resilient, then the central banks are not likely to consider interest rate cuts. Now, the UK economy and the EU economy is a lot more wobbly, but are they really willing to consider an interest rate cut when the US Federal Reserve has not cut yet? If they are, and they're pressured to do so because of lack of economic growth or economic decline or deterioration of the employment sector, then it will probably be very small and inconsistent economic cuts, interest rate cuts. So for example, 25 basis points and not month after month after month, especially in the EU, whereas the UK probably can allow slightly higher levels and faster levels of interest rate cuts. German elections, ladies and gentlemen. Now, I wanted people to keep this in mind. Normally, when we're looking at global economies, the right-wing politicians, if voted in, tend to have a more positive effect on the market, but that is not always the case. If we're following traditional economics, that tends to be the case, but it's not anywhere close to accurate or reality. For example, if Trump is voted in America, whether you like Trump or not, this is not something political in any way, shape, or form. But if he is, he's known to be against internationalism, really much against China and also against the European Union. Because of this, if he does start to spark trade wars, tariffs, and nationalism, then it can have an effect on the US stock market. If we look at the performance of the NASDAQ over the past 10 years, there's only been 2 years where the NASDAQ ended lower. That was in 2022. Why? Because there was the Ukraine-Russia conflict and there was very high consecutive interest rate hikes. So that was understandable. And keep in mind, it's fully corrected the next year. The only other occasion was 2018. We saw a slight decline, and this was triggered by Trump and his trade wars, tariffs, and so on and so forth. Now, again, people may like Trump. It's absolutely fine. These comments are nothing in any way, shape, or form political. He may be doing the best possible thing for America, but we must keep in mind that if voted in, it may scare investors, and some investors, even if it's just for a short period of time, may consider exiting the stock market. And it may dim the stock market performance over his term, especially if he is, again, going at the European Union and China and tariffs and taxes and so on and so forth. But traditionally speaking, the right-wing politicians, and if voted in, tend to do well. It doesn't mean, though, that if the left-wing politicians, for example, the Democrats, actually, excuse me, even though it may pain a lot of people to hear this, the Democrats actually saw quite a successful stock market. May not be related to them or their term, but nonetheless, that is the reality. Then the last thing I wanted to say is a lot of the time after elections, there is positive stock market movement. There is that correlation there. If we look at history, it's a weak correlation. It's not like, for example, gold against the US dollar, but nonetheless, we have to take it into consideration, and people need to be aware of it, especially if people are going to think about speculating a decline. But there's not really any proof or any reason for there to be a correlation there. Last thing I'll say as part of this slide: geopolitical tensions. Now, if the Red Sea crisis does actually trigger, how shall I say it? Disruptions, strong disruptions to shipping and to supply routes, and if that creates inflation, and in addition to this, if we start to see higher inflation and also higher oil prices because of the political tensions in the Middle East, then really that is a scenario again where we start to move away from possible interest rate cuts. If that scenario does come, the demand for currencies potentially can increase. Why? Because when there is that risk, when it does create a lower investor sentiment and a lower risk appetite amongst investors, individuals tend to want and prefer to keep their current capital in cash and to invest in safer assets such as bonds, such as currencies, such as fixed accounts, and avoid risk-based assets such as cryptocurrencies and the stock market. So we have to keep that into consideration. Now, since we're going to be looking at fundamental analysis, this isn't actually related to how fundamental analysis has changed or is going to change between 2023 to 2024. But we are looking at fundamental analysis, and we cannot look at fundamental analysis without looking at earnings and earnings season, and also looking at index components, because we are looking at weighted components, of course. And then we will look at technical analysis before we end today's webinar, because we are coming towards the end now. So if we look at Dow Jones, one of our most traded equity-based assets. So when we look at indices, the Dow Jones is one of the most traded, and it's for good reason, because it does have quite strong trends, a lot of volatility. When there is trends tend to last. Which is why it's so popular. It's understandable, is the NASDAQ. But nonetheless, the Dow Jones is very interesting, and it's actually been the most interesting over the past week. Why? Because earnings season has started. The earnings season started on Friday, and it's affected more than any other index, the Dow Jones so far. Whereas after this week, when we start looking at next week and the week after, it will start to affect more the NASDAQ and the S&P 500. So here, what we're looking at is earnings. Some earnings have been released, some earnings have not been released, some earnings predictions for the company performance have been released, some predictions have not been released. So something to keep in mind, if we look at the United Health Group stocks, they are the most influential stock within the Dow Jones. Now, some people may have never even heard of United Health Group. It's a very large medical and healthcare company in America and globally as well. They do have companies in other countries as well. They are known to be quite a stable stock, not very volatile, which is why the Dow Jones have it as one of its most influential stock. Now, if we look at their earnings per share was almost 3% higher than expected. Their revenue was almost 2.5% higher than expected, but nonetheless, the stock has declined. Stock declined by 3.32%. It was declined because of some comments from the board of directors. Also, keep in mind there was also comments in regards to the cost of medical, which really created some downward volatility, but nonetheless, both earnings and revenue is again, like it has over the past quarters, read higher than expectations. Nonetheless, though, of course, like we mentioned, we're looking at a decline. Now, Microsoft is the second most influential stock. It's expected to release their earnings on the 23rd of January, so not far away, just over a week. We don't have predictions just yet, but though, I can see a question. Please bear with me and I'll answer the question in a moment. But earnings is the stock performance over the past 5 days is more than 5% higher. Then Goldman Sachs, this is going to be released today. It may have already been released as we're speaking. I'll check that at the end of the webinar as well. So Goldman Sachs, keep in mind, this isn't actual figures. This is what is expected. Earnings are expected to be 23% lower. And keep in mind, Goldman Sachs has really struggled over the past 3 years. Also, revenue is expected to be 7% lower. The stock has declined over the past 5 days by 2.26. Home Depot, fourth most influential for the Dow Jones, will release their earnings on the 20th of February, so quite a way away. We don't have predictions just yet. The stock over the past 5 days has performed very, very well. It's actually been the best performance after Microsoft. And you have to keep in mind, Microsoft is a growth stock, so it's more volatile. So 3.58% is really, really high. Then you've got Amgen, which is expected to be released on the 6th of February. Now, their earnings are expected to be 8% lower, which isn't a big difference there, but their revenues are expected to be 17% higher. Their stock has increased over the past 5 days. Then you've got McDonald's. They're expected to see a worse quarter. Their stock has increased by similar amounts as well. Caterpillar doesn't have a prediction just yet. They will release theirs at the end of the month. Their stock is up 1%. So the main influence today, though, ladies and gentlemen, is going to be Goldman Sachs. Goldman Sachs is the third most influential stock for the Dow Jones. So anybody looking at the Dow Jones needs to also be looking at the quarterly earning reports of Goldman Sachs. As I said, over the past 5 days, already declined by 2.26%. Now that we're going to have the quarterly earnings release, it's going to have a lot more volatility. So we'll look at that in a moment as well. Now, what also individuals can do when they're analyzing the market, for example, if you're looking at the Dow Jones, this is a list of companies within the Dow Jones. So the index is following these stocks here. So the index is basically a fund. It's a weighted composite fund. In that fund, there's 30 stocks. Now, some stocks are more influential, some stocks are less influential. Depends on the weight. Because, for example, Microsoft, 6.7% of the fund is made up of Microsoft. But if we look at Boots Alliance, it's not even 0.5%. So, of course, Microsoft is more influential than Boots Alliance. So keep that into consideration. Why is this important? And this is significantly important, very simply because if most of the stocks are declining in the index, like we saw throughout the day, then we're most likely to see, of course, a potential decline. If all of these stocks are green, or most of them are green, again, we're most likely to see a price increase. At the moment, only 10% are trading higher, 90% are declining. That was taken from this morning. Since this morning, we've seen a very strong decline. Of course, you have to keep re-looking at this though. And I will show you this, how you can get access to it in a couple of moments. But we've got 2 more slides and then I'll show you that. So if we're looking at the Dow Jones on this setup, there's a couple of things which I've looked at. Here I've got a 75 bar exponential moving average, which is this red line here. If somebody needs help on how to add that to the charts, let me know and I can show you. And then at the bottom here, ladies and gentlemen, we have an RSI, which is known as a relative strength index. Again, if you need assistance adding that, let me know and I can show you on the MT5. Now, why is this helpful? Here you can see 25, 50, and 75. If the price is between 50 and 75, it's indicating strong buyers controlling the market. If it's between 25 and 50, it means sellers are controlling the market. Now, if the price is below, it means there's poor price sentiment. If the price is below this red line, poor price sentiment. If the price is above, it means strong price sentiment. Now, we as traders, we're trading and speculating in the short term because we're trading using leverage and derivatives. Most traders anyway. Some people may have different methodologies. Now, would you want to be trading when the indication is, sorry, would you want to be speculating upwards and trading upwards if the indication is indicating that sellers are controlling the market and there's a poor sentiment in the market? At the same time, would you want to speculate downwards when the indications are buyers control the market and there's a strong price sentiment? This is why this chart is very important. You can see throughout the day, this is a price movement throughout the day. Throughout the day, the price has been declining. It's declined actually for the first 18 hours. The first 10 hours of the first 10 hours of the Asian session. It also declined at the very beginning of the European session as well. So only now started to see some upward price increase that we're getting close to the US Open. Other than that, though, we've seen many hours of downward price movement, and we had this indication here and this strategy to help us to determine it. Also, if you look at the performance of other markets, because this is the Dow Jones, if you look at the performance of other markets, for example, Asian stocks, European stocks, they have been declining as well. So that is also an indication before the US market opened, how have Asian and European stocks performed? Because if all the stock market is declining, are you comfortable to speculate the US market will increase? And this is a specific reason you believe so. Now here, ladies and gentlemen, we've got crossovers. So we've got 2 moving averages. We have we've got the red, which is a 16 bar moving average, and then we've got the yellowy orange here, which is a 8 bar exponential moving average. So we have a simple and an exponential. Now, because of this, they cross over one against the other. Now, when it crosses downwards, for example, you have a crossover downwards here, a crossover downwards here. We also have a downward crossover here. We had a downward crossover here. We had a downward crossover here as well, and another downward crossover here. Now, so we had 1, 2, 3, 4, 5, 6 crossovers at different prices, all indicating downward price movement. Now, the price declined all the way down to here. Now, this is a very big decline, ladies and gentlemen. All indications give us the right indication of downward price movement, even though we've seen quite a strong upward price movement here. Now, this upward price movement very simply may just be increasing and will increase and reach this red line before finding more downward price movement again, like we saw here, and like we saw here, like we saw here, and like we saw here as well. So keep that in mind, ladies and gentlemen. Now that brings us to the end of today's webinar. But what I'm going to do though is I'm going to show you the Dow Jones. Let's go to my MT5. We'll show you the Dow Jones and its performance, and I also will show you as well how to get access to components on the market. So let me share a different screen with you. Here we go. So if we go to Google like this, we type in, even if somebody's looking at the NASDAQ, for example, maybe a different asset, but let's look at the Dow Jones. We type in Dow Jones components like this. We click here. It shows us all the Dow Jones components, ladies and gentlemen. So you can see most of the Dow Jones components is in the red. Okay, so we've got 1, 2, 3, 4, 5, 6, 7, 8 out of the 30 in red. Okay, the only thing which is positive about this, what we're looking at this here, is that the top 4 most influential stocks are seeing a price increase. The only other thing which is positive is Goldman Sachs has seen a strong price increase. Most likely Goldman Sachs's earnings was higher than expected. So let's have a look at that. So you can see Goldman Sachs increased 1.79%. So most likely they did see higher earnings than expected. So let's look at this here, for example. Yes, so the company did indeed see higher than expected earnings. This is why we also saw 1.79% increase today before market opens. But the only negative factor though, guys, is that of course everything else, most of the stocks are declining. But a positive factor is all the most important stocks, the top 4 most important stocks are looking at a price increase. So potentially that can even indicate mixed price movements within the market. If we look at that, the price movements of the Dow Jones, we did see an upward price movement here, but again, we're starting to see a decline again after that, ladies and gentlemen. If we look at the overall price movement, we really can see a decline. We saw some bullish price movement and we went back to that previous price range, most likely because of the higher earnings from Goldman Sachs. But again, we're not seeing, we're not holding on to momentum after that. Now, if we see another downward crossover, then we can be looking at a possible indication of a more bearish price movement. So, ladies and gentlemen, that brings us to the end of today's webinar. If anybody has any questions, feel free to ask now. So I've got a question here. I've followed the instructions on the HFM website to download the MT5, but the server is not coming up. What else should I do? If you're on the website, there's a download button. When you click the download button, it should come up with the download. And you have to keep on clicking next until you finish, and then you will get access to the MT5. Now, for whatever reason you're struggling with that, or maybe the computer is not allowing it, keep in mind the MacBook may not allow it. So if it's a MacBook, you have to keep in mind that maybe why. You can speak to our support team. The support team is available 24 hours a day. If you go to our website and click on live chat, the support team will get straight back to you and they can help you step by step, even potentially even giving you a call and going through it step by step on how to download the MT5. So that's your best bet. Otherwise, it should be working. Any other questions, ladies and gentlemen? Okay, I cannot see any other questions. So trade safe, trade responsibly, and hopefully we'll see you very soon on our next webinar. I've got a question now, actually. The sentiment at the moment is bearish at the moment, potentially, very simply because of comments from the central banks and finance ministers, especially in Davos. But it's all going to be dependent on earnings, though. If earnings are all higher than expected, it will not be as dovish as previously thought. So it all really depends. The main thing is, will inflation decline? Are we going to see interest rate cuts and earnings, of course? These three things will determine if it's going to be bearish at the moment. But of course, we're looking at the 75 bar EMA, then it is indicating bearish in the medium term. So even though we might see upward price movement today, in the medium term is indicating bearish. Now, if it increases and crosses above it, then it will start to indicate bullish. So it's a completely different scenario. Somebody's mentioned the January effect. Look, as an economist myself, we don't really believe in the January effect. It's kind of a mystery, something which is known amongst traders, but not really backed statistically. However, it's down to you if you want to follow the January effect. What website can you get fundamental news? You can get our website, of course. Can we get a call recorded on the webinar? Yes, we can. The recording will be available to you. So let's go back to Google. Or even if you don't want to go straight to our website, if you type in HFM analysis like this, it brings up analysis for you. Alternatively, what you can do if you don't want to do it from Google, type in HFM. Then you go to tools and education, and then go to market news or exclusive analysis. It will take you to the section where fundamental analysis is available. May require login. From what I can see, it doesn't know. There we go. So if you go to market news and then you click on daily market review, you can see exactly analysis. So this is the analysis from approximately 6-7 hours ago. And you can see dollar demand rises, global stocks tumble, and you can indeed see that. Over the past 3, 4, 5 hours, the dollar has risen and stocks have indeed tumbled. Here we're looking at yesterday Japanese yen. Day before that we looked at US inflation. Each day, then before that we'll look at Bitcoin. Each day there will be another analysis. So this is something that can be massively helpful. So guys, let's end today's webinar. Trade safe, trade responsibly, and hopefully we'll see you very, very soon. In the meantime, goodbye.